All right, I just wanted to go through my morning routine here with the chart since it's been a little while since I've done that, and I was out a little bit last week with a pretty nasty cold. As you can probably still hear in my voice today, it's not that great. So, what I do in my morning routine, especially beginning of the week, is we start with longer time frames first, work our way back. We want to see where the market is currently. So I'm going to be building the SPY analysis with you guys this morning through here. And what we're looking at here is just the monthly chart on SPY. And I've got the Fibonacci retracement on this big move since you can see here April of 20 when we had the big dip, the big COVID dip, all the way up to the highs that came after. I mean, we got a low here from that low is 218.26 all the way up to 479.98. That's pretty big. So this move, a few of the things to just kind of look at before we get here. So you've got some background that I've already kind of exercised. This midline is the average. The average price here taken on a 20 period moving average, and that is a solid average to use on any time frame. So you got to take into reference, first of all, what kind of time frame you're looking at. So on the big picture monthly chart here, you can see where back in 2015 we had some sideways action, market pulled back some. If you were trading then, you remember that. And we had a couple of blips below the 20, but it didn't hang out for too terribly long. And then actually we can kind of measure what kind of time frame that was. 220 days. So actually good bit of a year there. But it exploded afterwards and it stayed above that for 953 days. So that's a good long run. We had a pullback there again in 2018. That was just 2 bars there, very quick, but see how it's holding the monthly 20. And then we had a sharp decline, that was COVID, but even COVID was just 2 bars below it, really. And the next one actually closed above it. So that was a very quick bounce and rebound. Now that brings us into the move that we are just experiencing pullback on now. So that move up lasted 690 days. That complete move up was a good 120% move. And now we are experiencing a pullback, and we have been, so that's no surprise. But what is of notice is if you compare where price is according to the average, first of all, the gap here between the average and the highs was about 17% there. So that was a tad extreme. 12% there. Going into COVID, it got as high as 16, 17% almost. What was a little bit obscene was this present move, 19%. You can see where it's really 20% pretty much above the average, 21%. So when you're seeing price that far above the average price, as we do on an hourly or a 15-minute or any other sort of time frame, that is a large extension over the average. It's got to come back to the average at some point. And you can see on the monthly chart here, there's a couple of ways it does that. When we're in a good steady uptrend, this red line here is the 10 period moving average. The 10 holds pretty good. Breaking the 10 is a pretty good notification that things have changed. You can see here, once price gets back above in 2016, it stays above not only the 10 but the 5. 5 is staying above the 5 is pretty strong indeed. But even when it breaks down, it still stays above the 10 until it finally breaks down, breaks below the 10. Then of course it breaks below the 20 as well. You can see the pattern there. Again, breaks below the 5 and the 10. Then of course it breaks below the 20. We have the same thing here. Breaks below the 10. Zoom that in a little bit for you. Breaks below the 10, pretty good indication. Price is going to break below the 20. It did. And there you go. So that's what we're looking at now. What is interesting of note right now in the current market situation we're in is that we have price below the 20 for a much more extended period of time than we have seen in the last 10 years. We could even move this time frame up and let's do 20 years. The last time price hung out below the 20 for this long was, as you can see, in 2008. Now, granted, this is right now nothing like 2008 because price went the other extreme and dipped extremely below the 20 for quite a period of time. You know, that was below, it was below the 20 for 590 days or thereabouts. So this is something a little bit different than that, obviously. We have inflation, we're getting a mild recession, we're in a recession, no matter what they say. But what we're seeing on the chart, what the chart is telling us is that you notice how this was a pretty smooth ride for an extended period of time. It went down pretty sharp, but then we had pretty smooth ups and it got a little bit extended here, as you can see in 2012, 2013, things started heating up a little bit. It cooled off a little bit. They really heated up after 2016. So 2016, things heated up pretty good. They pulled back a little bit. They heated up a little bit faster. In 19, pulled back a little bit harder. And then they heated up a lot faster. And if you go back and look and see what the constant, and I won't go through my long theory and everything about the Federal Reserve, but if you look at what is similar, and I was trading during these time periods, and in 2018, 17, there was a quite a big crisis at the Federal Reserve window where banks were just swallowing as much money in the overnight window. The overnight window, by the way, was created way back here for the Federal Reserve to supply extra money to banks because banks had collapsed, lending was tough. It was supposed to be a temporary measure to give banks the funding that they needed. The other thing that was supposed to be temporary was 0% rates, and neither of those things were temporary. So these temporary measures that were supposed to support the market in a time of trouble stayed on even after the market rebounded 600%. Now, that makes no sense from the perspective of an economic perspective. The purpose of those tools, they were supposed to be faded out. The Federal Reserve was supposed to purchase back all the bonds that it had sold to create money out of thin air back in 2009, 2008 to support the market. In 2012, they did some more of that, putting some money out there. Things did not, even though the market rebounded a fair amount, you know, the overall market, like the housing market, things like that, they didn't really ramp up like they had going into 2008, 2007. And so I don't know what the thinking was. They kept rates low to try to support some things. I don't know. Let the market work itself out, but they didn't raise rates. So coming into 2018, when that Fed window crisis was happening, it was very quiet. It wasn't like on the 10 o'clock news or anything like that, but started seeing these extreme moves up when price should have come down. For instance, Apple earnings was good, but it wasn't as good as previous quarters. But Apple was making outsized moves post earnings that didn't make any sense compared to the price to earnings ratio and several other fundamentals. I don't trade on fundamentals, but I do look at them and think, okay, is the market healthy? Is this what it should be doing? And it was clear that the market was unhealthy, that there was extra cash floating in the market that didn't need to be there, that was making the market go higher faster than it should have. Anyways, again, I'll save some of those deep dive on the Federal Reserve for later. The point is, What we see the move up here is that Federal Reserve money being floated out into the market. The banks get that money, and then what was happening is instead of giving out loans, instead of doing a lot of things that they had done in 2007, 2006, before the housing crisis with that money, um, what they were doing instead is they were putting that money in the market. And so it was inflating the market. That's what we see here is all that extra money that was supposed to go to banks to loan out to people for cars, for houses, things like that. That's not where they spent the money. They took the money and they invested it for themselves. So, therefore, this pullback in the market, despite inflation, despite everything else that was going on unhealthy in the market stayed high because the rates were low and the banks were using that money to invest in Apple and Microsoft and whatever else, right? When that cheap money became no longer available, that's when the market started to pull back because this really pretty much all of this over 300 is just extra bank money that shouldn't even be in the market. So, anyways, so just to understand the perspective of what we're looking at here. So when that easy money, cheap money, became a little less cheap, the market pulled back. And actually, in the scheme of things, looking here at the monthly chart, that pullback is not really that big of a deal, honestly. Um, Knowing that really pretty much a lot of the market increased since 2017. And if we just look at that, so we're talking about a doubling of the market. That doubling of the market, a good bit of that has to do with money created out of thin air, Federal Reserve money. And so that's got to be corrected in the market. Even the Federal Reserve is because they can move the market and they can push things. Even the Federal Reserve gets a correction from the market. Those actions have to be corrected. The market has to have balance. The beautiful thing about the market is you can't outsmart it. The Federal Reserve has enough power to push it and manipulate it. However, even the Federal Reserve, because we still have mostly a free market in the United States, they're not the only actor in the market, right? We have normal, regular people. There's millions of them. We have other businesses, and so on and so forth. The other thing that is I am going to go a little bit on a tangent. The other thing that is kind of dangerous here in this pullback, what we should see happening, we're seeing the Federal Reserve raise rates, and that is good. That should be happening. But what we're not seeing so much of is we're not necessarily seeing the appetite for risk really pull back as much in certain areas. We are seeing it in a lot of areas. Obviously, Apple stock. I mean, let's just look at Apple real quick because it's a big indicator. Apple stock is down quite a bit. We're seeing layoffs all over tech sectors. But so that is happening. But the federal government is still pulling money from the Fed. They are still pulling out a lot of money for bills. We're raising the debt ceiling. These things really shouldn't be happening right now. If we were really correctly pricing in risk. And so why that's not happening, why government doesn't really seem to care, couldn't tell you. But that is the situation we're in. So that is sort of the dangerous undertone. The federal government should be putting its debts in line with, or its budget rather, in line with its debts instead of expanding its debt. That is going to have another negative effect on the market. Government debt has a dragging effect on the market. It will also prolong inflation, so that will have another dragging effect on the market. These things are going to affect the market that we're seeing right now. We may see some pops But until things like federal government debt and inflation and some other issues get resolved, I believe that the market on the monthly chart is going to stay below the 20. Now, diving into this piece now that my rant is over. Thank you for listening to my rant. What the market's going to see is this 20 period moving average. The average price on a monthly basis is right around 420, you see here. But this moving average, you can see one of the interesting things over the last 25 years here that we have pulled up on the chart. The last time the average was pointing down was really not until 2009, 2010. And that's what's interesting for the longer term. Again, looking at a monthly chart, so this is longer term. This month is really going to matter a lot, because for the December candle, we saw the 20 period moving average pointing down. Again, for the first time in a long, long time. That doesn't necessarily mean that we're going to see the exact same repeat of 2008, 2009 in the market. Not that it shouldn't. We should see price naturally pull back to around 300, I think. But it just means that at the very least, the market is not getting out of this, what we're in right now, for a while. And I'll pull down to the lower time frames and show you what supported, some more evidence on the chart that supports that. What I'm seeing looking at this right now is that there is a chance that the market pulls back further. But looking at the chart right now, with price bundled in this area for an extended period of time, below the 20 period moving average, above the 50% retracement, however, this area, 418 to 350, basically, let's call it, is going to be a sideways market area. And that's what it looks like, 350 to 420. That's about what we got. From the monthly chart, that's what I see. Price is going to hover around 380 and be in this general vicinity where it should not have even gone to back in 2020, right? It should have been a slower and steadier move up. And if you just kind of track that, right? So let's do that real quick. Let's track like the move up here. Okay? And let's move it. Oh, I did not mean to do that. Let's activate that drawing and let's move it to here. So if you see the move up that kind of should have been, maybe, you can really put these things wherever you want to. Post-COVID, if we had not gotten all of the money that should not have been pumped into the market post-COVID, they should not have dumped onto it like it was 2009. More money was open from the Federal Reserve post-COVID than ever before, and rates were already at 0%, so it made no sense. And that's why they're having to pull back so quickly after that, because the rates should have been 5% 2 years ago, 3 years ago. Anyways, so we see that the more natural move of where we are right now really kind of puts us at 400 being kind of the peak coming up here. Price didn't do that. Instead, it went way above it to 480, and now it's pulling back down. So price is really more or less, even though we've seen this kind of dramatic like pop up, pull back down, and everybody's, price is more or less naturally where it should have been. And see, this is where I say even the Federal Reserve has to obey the market. The market will win at the end of the day. This is more or less naturally where price should have been. It's just that we popped way up, took a bunch of greedy people up here and taught them a lesson, and they lost a lot of money on the way down. That's what the market will do to you. So anyways, that's the monthly chart. in a very long recap. Thank you for bearing with me. Let's get down to the weekly chart. So on the weekly chart, what we're looking at here is this is not too crazy of a move to expect, right? When you have a very hard move up, this is a long period of downward consolidation, but it's really not that crazy. So, and we have some distinct trend lines that we can see are working themselves out. So this trend line, downtrend line over the top is most important. And you can see on the weekly chart, it did not break out of that. Now, going back to the 20-period moving average again, price broke below it. COVID. You call it COVID. It wasn't, I won't get into that right now. But this is when it broke back over the top again. You can see same thing we were seeing on the monthly chart. The 10-period moving average was a pretty solid support area. Above the 5 was when the market was really strong. When it breaks below the 10, it goes to the 20 every time. But we saw it quickly recover each time, right? These were all very quick recovers. Break below, quick recover. Break below, quick recover. It got a little more testy here at the end of, well, that was 2 years ago now. At the end of 21, it was obvious that the market was extended and we were going to get punished. And people got greedy anyways. And then it broke below, a solid break below the 20, rejected at the 20, and the market continues back down. What's interesting about the characteristics of the 20-period moving average right now, you can see very strong move up, pointing up. It's pointing down. But what we're seeing on the weekly right here that supports the theory I was telling you earlier about this is probably going to be a ranged market for some time is the fact that the weekly 20 period is really, since October, has really just kind of been settling, right? We saw it pretty much straight down for a while, and it's really just kind of sideways. Now, what this is going to kind of look like is that this area right here that we're seeing, this 420 to 350 area, is going to see some more consolidation. We might see a break over 400 and it push to 420 again, and then it get rejected and come all the way back down to 350 again, and just kind of do that for the next year. That may be what happens, it may not be. I don't know. I don't see the market going back to 480 this year, though. I just don't. And I don't necessarily see the market either going to like 220 back to the COVID lows. I don't see that necessarily happening either. I think there's a lot of things that need to be worked out. Supply chain issues back here in 2020, right? And then oversupply of money, poor monetary policy issues in 21. They got corrected in 22. And we're going to need to work out inflation. We're going to need to work out interest rates. We're going to need to work out that oversupply of money. And I know that we have the debt ceiling thing going on right now, but and that it's an event, it will have a drag as the federal government perceives a very low risk and a high appetite for debt. That is going to cause the Federal Reserve to need to print money, create money out of thin air. It's going to prolong inflation. That having a debt higher than the GDP, extending ourselves essentially by raising the debt ceiling, is going to also have a drag because the economy is not going to be growing like it was in that period where the market corrected the COVID downturn. We're not going to see these huge GDP increases, but we're going to see debt increases. So that is going to create a drag on the market along with inflation. What we really need to see is deflation. I know that's a bad, if you're at the Federal Reserve, you're looking at me like I'm crazy. We don't need to see deflation. We need to see deflation. We need to see prices come back down. And that will happen in some way, shape, or form. either inflation will remain high for an extended period of time, or we will see deflation to correct the poor monetary policy to bring prices back to what they actually should be. One of those two things will happen, and there's no other choice. Either our money keeps getting devalued, and we have to just sort of slowly correct that over time to make things kind of balance out. It's really bad for people like you and me. Or we have to have deflation, which used to be the natural occurrence of the market. When price got inflated, we would have a period of deflation to keep things kind of even. But the Federal Reserve doesn't like for that to happen because the rich people lose money. Anyways, so weekly chart here, we're seeing the 20 kind of flattening out, which sort of goes along with my theory that we're going to see a period of stagflation where market just kind of goes sideways, and we'll see. Breaking down to the daily chart now, we kind of see this on a little bit closer level, and we've seen price hit this downtrend line and get rejected, and we're seeing that again. So this is bringing it closer to what we can actually work on now. This is what we're seeing. So we've got price rejected several times. This trend line is very firm. It's held very well. We have seen the 20-period moving average here again. Price breaks below it, gets rejected. We have a nice little period of a downtrend. Price breaks above it, gets supported by it. We have a nice little period of uptrend. Again, rinse and repeat. What happened a little bit different that said that the market was more going to go sideways instead of just break down completely was this period right here. And we traded this quite a bit, talked about it quite a bit. And I mentioned that breaking above it and holding above it would be a period of moving up. And this is where I said I think the market may break above this and head up to 420, but not go much higher. I think that's kind of where we're leading into now. And I'll tell you on the daily chart what leads me to believe that. So this sideways period of consolidation is very, very interesting. It repeats itself in the market quite a bit. We see it again right here. Okay. These periods where price doesn't just kind of go up and down, moving in a certain direction in a trend. Instead, price is consolidating and creating a base. These bases can be kind of messy. You can see that we had sort of the opposite effect up here. Okay. So whenever it breaks one way or another, we kind of see who was the winner of that consolidation, and it gives you an idea of how the people in the market are going to act moving forward. So since we have a base and then another base, this is a typical uptrend base. And if we plot this, we can kind of see where the market is heading into the future. But what I think is going to happen here is that because we have this nice base on base, price will break out of it, it'll go higher, and then it'll pull back down, create another base, and then it'll break out and go higher. So that's where I think that since we had this at max 10% move up, max 10% move up might max out around 425 maybe, might break 420 and go up to 425. But usually the second and third moves aren't quite as powerful as the first. That's kind of how I see what we're having going on right now. A few other things of note that we should pay attention to. The 200 period moving average on the daily chart. Price has been firmly below it for quite some time, and yet price broke above it, rejected, broke above it, rejected, but we're seeing price coming back into it. And the more times price touches or goes against a period of, either support or resistance, the more likely we are to see that break. So we're already seeing since December. So in the last month, we've seen price hit this downtrend line quite a few times, and it's been rejected each time. But again, the more times it goes after that resistance area, the more likely we are to see it break. Now, granted, on the other end, we've got kind of the same sort of thing on this line. So we need to pay attention to both as the two prices you see here are converging. And so we have this consolidation area that we need to look for a break on either side. So 385, 400, one of the two. What makes this pattern more bullish than bearish right now is the 20-period moving average. So if we look at this, we can see where price pulled back and it broke below and it kind of didn't know, and then it popped way back up, and then like it was sort of jumbled. What I see here is more organization of the chaos. So in this area, we have a lot more fear. We have a lot of people playing on that. So you have the market in a bear market doing extreme highs, extreme lows. It breaks out really hard and then pulls back really fast, right? And that's what we see here. What we're seeing since January is not quite as much of that. And yes, it is still doing that. But if you just look at the size of these bars compared to the size of the bars in December, November, October, the market is calming down a little bit. The other thing that tells me that this is more of on the bullish side, price pulled back to the daily 20, but it didn't even pull all the way back, if you notice. You see here in other times, price pulled back to the 20 and either was all over the top of it or broke below it and had to find its way back above, right? But this time, the 20 is pointing up and price is holding above it. It pulled back, and we kind of expected that when price got up here to the trend line, it would pull back to at least the 20, but it didn't pull through it. It pulled towards it, didn't even all the way touch it. That's more bullish. That's something that we have to keep in mind. Now, we had a very bullish candle on Friday, closing at its highs, but closing below the 200. So right now we've got this area right here that is important. Okay, and then of course breaking above the prior high is going to be important. The trend line is going to be important, but this area right here is important. Can price hold above the daily 200, or does daily 200 remain resistance? Test number one. Then the downtrend line, does it remain resistance, or can price hold above that line? As you can see, price has been above the trend line many times, but it has not been able to hold above the trend line for a day. I haven't been able to do it. Didn't do it here. But that now becomes the test. Does price meet the trend line around 398, or does it get, well, let's say it meets it. When it meets it, does it hold above it? Do we get a close above the trend line? Do we get a close above these prior highs? That tells you, if that happens, that's going to tell you price is going to 418. Well, let's just say 410 first, right? 410 first, 420 next. And you can look back on previous time periods. We've got this area, obviously, that needs to be resolved. This area above 410. I mean, really, this whole area right here is kind of no man's land, that whole area. That whole area needs to be repaired from where price shot down through it. So we could see price going to 420, repairing this area. And then it's a guess of whether it stays there or not. A lot can happen. I'm not predicting the market way out into the future. I'm just seeing what the possibilities are, and when we get there, what the headwinds are going to be and how we're going to react. Now, the other possibility, of course, is that price gets completely rejected here at the trend line and we see it come back into this prior consolidation area. There are buyers here. There are people who are saying, you know, if price comes back to 380, I'm buying, because that's all they were doing right through here, right? They were buying. The thing that's going to trip us up in this area is there were people who got long. Look at this candle right here. Okay, there were people who got long here, and they're stuck, right? Price is now below that. They're losing money, and they're like, you know what? I shouldn't have gone long. And so when price comes back, they're gonna get out for break even. So there's going to be some of those headwinds here. Same thing over here. Somebody got long here, right? Somebody got long here. They got long here. Somebody got long there. And so when price comes back into these areas, it's going to get fought against because those people that got long are going to want to get out. I mean, you can imagine if you got long at 420 and price comes back to 420, what are you thinking? I need to get out. I need to get my money back. So I digress. Price back around 380, I think is pretty strong. A buyer's market. Something could happen to push it through it. If it pushes it through it, we break this trend line down here, then, you know, we're back to 365. We're back to 350 potentially. That's what can happen. Let's get a little bit close here. So let's look at the 4 hour. You can see how that plays out a little bit closer. Rejected at the trend line, rejected at the trend line. This is what we're looking for. Do we get a repeat of this right here, this right here, this right here? Do we get a repeat of that? Or does it hold above and close? Let's look closer to what we're going to have happen today. So interesting on the 15-minute chart. This is kind of what I wanted to point out here. So we've got, let's draw a box actually. We've got this area, right? So we'll put that over here. We've got this area that price is starting to pull into. Okay, that's this prior area that price was holding on to for quite some time and then lost finally last Wednesday. So Wednesday, when it lost it, it created this, I don't even want to call it a cup and handle because this is not the time period to look for cup and handles, but that's kind of what we're seeing here, where we've got price retracing 2/3 of the from top to bottom, creating a base, extending out. Of course, that's overnight action, so it's not really, again, this is not really what you look for, but this is kind of what we're seeing. So it's leading me to believe that today that we're going to see a breakout back towards 400 in this area where price had some pretty strong consolidation, and there was actually some pretty good value built around 398 in this time period. So are we going to see that hold out and those people who are strong around 398 stay strong around 398? If they stay strong around 398, it can pull price. Now remember the problem, if you go back to last week and the week before when price was doing that, the problem was people were strong around 398, but they had no conviction over 400. And so we saw repeated rejections at 400 where the sellers just showed up at 400 and just slapped the tar out of it, right? Push price, that eventually pushed price all the way back down to 388. But here we are pretty quickly after that, seeing price pull straight back up. So we have to test those sellers and those buyers again. Are those sellers still convinced that 400 is the place to go short? They made their money, and so they may not be as convinced anymore. The people who are at 398, it could be the opposite effect, right? They bought at 398, bought at 398, price dipped, they get a little bit scared. Maybe they sell at 398 this time instead of buying. We don't know. That's what we're going to look for today, tomorrow, this week. So that's what we need to pay attention to. Now, it's a lot more bearish if price just never even makes it into 398 territory. Really bearish outcome for today is that price pushes towards 398 and either doesn't even tap the trend line or tap the trend line, just go straight down. And so then we would be looking at 395. Below 395, we'd be looking at 392. We'd be looking at 390. Okay? That is the bearish play for today. The really bullish play for today is price quickly makes its way above the trend line to 398. 398 holds, and maybe it pushes to 400. It doesn't even have to. If price just holds in the 398 area and starts to accumulate buyers there, then it will eventually push above 400. So that is the more bullish outcome. Kind of the in-between outcome is we could see price push to 398. Nah, maybe not get strongly rejected, but just not quite do it yet, right? It's waiting on some more buyers. And so we hang out in a 395 to maybe 397 area. That's sort of the in-between scenario that we could see. Again, we're looking at knowing these price levels and what they mean from all the way in the past to now. We're looking at how the market participants are going to react. And the money that you and I spend in the market has no effect, right? We're looking at the people are going to make bigger decisions with billions of dollars. Are you going to go long? So you made some bets going long at 398. You think the market's going to go a little bit higher because of whatever, right? I don't need to get into your head. I'd spend way too much time trying to do that. That would not be fruitful. So all I need to know is back at 398, are you committed? Are you in as a buyer still? Are you committed at 398? Or have you lost your commitment? That's what I need to know. When it gets back to 400, sellers, people that are going short, they've repeatedly gone short at 400. It was an easy way to make money. If price gets back to 400, what I need to know, what I need to see, what I'm going to watch the chart for is price gets back to 400. Are you committed still as a seller? Are those big sellers still committed at 400? Or are they not? If they're not as committed, price is going to go through 400. It's as simple as that. The market is not that complicated. What we have done this morning is we have looked at the price levels and seen how prices reacted, what those things mean, from a bigger picture down to a 15-minute chart here. And so looking at the 15-minute chart, what's going to progress in the next few days is going to be dependent on how those buyers and sellers in the market participate. Now, again, like I told you, the other scenario is that we could actually see price be non-committal because nobody really wants to commit one way or another, and that's the other scenario. So that's it for what I have this morning. I am going to post this in the SPY analysis channel, and then we will kind of digest that. Look forward to your questions. Hope to do this on a more often basis. Today was long, really long, because it's been a while since I've done this, and so I want to do some catch up. But I will be in the trading floor if you guys need any assistance.